If you've been watching the mortgage market this week, and I know a lot of you have, you'll know it's been a very significant 7 days. Rate increases from lenders across the market, some serious economic data landing, and a global backdrop that is making life very complicated for anybody trying to forecast where rates are going next. So there's a lot to get through. Let's have a look at it. Now, before I get into this, if you're new here, make sure you hit subscribe. I'm Craig, a broker with over 25 years experience, and I do this every week. Straight talking mortgage and property market analysis without the fluff. So let's get into it. Let's start with lenders and the rate movements this week, because this is where most of you feel it most directly. It has been a very active week for rate increases. Across the market, lenders have been moving rates upwards. And we're not talking small adjustments either. In some cases, lenders like Virgin Money have increased some of their rates by up to 0.7%, and that is a significant move. And they weren't alone either. Lenders across the board have been repricing upwards all week long. If you're sitting on a variable rate or a tracker, this matters. If you're coming up for renewal in the next few months, this matters. Don't sit on your hands waiting for rates to fall. Speak to a broker as soon as possible and get your options mapped out now, because the sooner you secure something, the better. So why are lenders moving their rates? Well, let's look at swap rates, because swap rates are what lenders use to price fixed rate mortgages. And right now, they're telling a very interesting story. The 2-year swap rate is currently sitting at 4.290%, and the 5-year is at 4.188%. Now, exactly a year ago, those figures were 4.052% and 4.021% respectively. So we are noticeably higher across the board compared to 12 months ago. That's a meaningful shift, and it goes a long way to explaining why lenders are moving the way they are this week. The market had been hoping for a clearer path downward on swap rates, and that path is looking a lot less certain right now. And the economic data this week tells you exactly why. Now, just a quick note on lender criteria, and whilst there have been changes, there's nothing significant to report this week. That's a story for another week, because this week's been all about rate increases. Okay, so moving on to the economic data and inflation first. The ONS confirmed this week that CPI, the Consumer Price Index, held at 3% in the 12 months to February, unchanged from January. And on the surface, that sounds stable. But if you look underneath, there are some really uncomfortable details. Core CPI, that's inflation excluding energy, food, alcohol and tobacco, actually ticked up from 3.1 to 3.2%. Services inflation eased very slightly from 4.4 to 4.3%, but it is still well above where the Bank of England wants it. And here's the bit that I think a lot of people missed in the headlines. The ONS noted that petrol prices were a downward driver in February, but crucially, that data was collected before the escalation in the Middle East and the subsequent rise in crude oil prices. So what we're looking at in this report may actually be a more flattering picture than what the March data is going to show, so watch this space. This brings me on to the OECD, the Organisation for Economic Cooperation and Development, who published their interim economic outlook this week. And it makes for pretty sobering reading if you're hoping for rapid mortgage rate relief. They've cut their UK GDP growth forecast for this year to just 0.7%. That's down from their previous forecast of 1.2%, a cut of 0.5%. And that is the largest downgrade in growth projections for any rich economy in this update. It puts the UK second from the bottom in the G7 growth table. The reason? The conflict in the Middle East, rising energy prices, and the inflationary pressure that flows from that. The OECD is warning that higher energy costs will push UK inflation to the second highest level in the G7 this year. Now, 0.7 growth is not a recession, but it is fragile. 1 or 2 weak quarters and you're there. And this creates a very awkward position for the Bank of England. Weak growth says cut rates. Rising inflation says don't. The tension, that push and pull, is exactly why you shouldn't be banking on sharp rate cuts arriving anytime soon. House prices next. So the ONS reported that average UK house prices increased by 1.3% in the 12 months to January 26, bringing the average UK home to £268,000. That's down from 1.9 growth in December, so momentum is easing. England at 1.1% is the drag. Wales came in at 2%, Scotland at 1.3%, and outside of England, affordability relative to income is generally better, and that's keeping those markets a bit more active. One important caveat though is that January data always needs a little bit of context, because some of this slowdown is likely mechanical, reflecting reduced activity over the festive period. So I wouldn't read a crash into this, but the direction of travel is definitely clear. The market is cooling. For those of you who are landlords or renting, let's take a quick look at rents. Average UK private rents increased by 3.5% in the 12 months to February, holding steady at £1,374 a month. So despite all the noise about the housing market, rental inflation is not going away. The regional picture is really striking. England's northeast saw rental inflation of 7.6%, the highest in the country. Meanwhile, London came in at just 1.7%, the lowest in England. That's a real reversal of the story we've been telling about London rents for years. It suggests some kind of ceiling has been hit in the capital, possibly a combination of outmigration, affordability limits, and some supply coming through. Wales saw 5.5% rental inflation, Northern Ireland 5.2%. These markets historically had more breathing room for renters, so that room is disappearing fast. And finally, on the economic data, affordability. The ONS published some figures showing that in 2025, the median average home in England cost 7.6 times the median full-time earnings. That's £300,000 against earnings of £39,300. In Wales, the ratio was 6 times, £213,000 against £35,800 of earnings. Now, believe it or not, affordability has actually improved since 2021. Earnings have risen 25% over that period, while house prices have risen just 5%. So in relative terms, things are better than they were at the peak, but 7.6 times earnings is still historically elevated. Improved doesn't mean affordable. It means slightly less unaffordable. And this is perhaps why we are now seeing some lenders offering up to 7 times your salary. The regional contrast is extraordinary. Hindburn and Kingston upon Hill are the most affordable in England and Wales, both at 4.1 times earnings. But Kensington and Chelsea sits at 25.2 times. In London, overall, you'd need the average price plus an extra £279,000 on top of 5 times earnings just to buy the average home. So what does all of this actually mean for you? Well, here's my honest read. Rates are not falling meaningfully in the near term. The data just doesn't support it. Inflation is sticky, the Bank of England is boxed in, and lenders are repricing upwards right now, not downwards. Anyone who was hoping for a sharp drop in mortgage rates in the first half of this year really needs to recalibrate those expectations. So what do I think happens next? Well, let me be straight with you. I don't see meaningful base rate cuts coming anytime soon. The Bank of England is caught in a very difficult position. The economy is weakening, yes, but inflation is not under control. Core inflation is actually moving in the wrong direction. Services inflation is barely shifting, and with an oil price shock potentially feeding through into the spring data, the picture could look worse before it looks any better. Cutting rates into rising inflation is not something the bank can afford to do, so if you're sitting there waiting for rate cuts to rescue your mortgage situation, I wouldn't base your plans on that happening this year. Plan for rates staying where they are. Anything else is going to be a bonus. So who can benefit right now? Well, first up, people who were declined or turned away by a lender 2 or 3 years ago. Earnings have risen 25% since 2021, while house prices have risen just 5%. Your affordability position may be genuinely better than the last time someone ran the numbers. It's worth revisiting, and that's exactly what a broker is for. Second, anyone coming off a fixed rate in the next 3 to 6 months. Don't wait for rates to fall before you act. Lock in a product now. Review it if the market moves, because the cost of waiting and being caught on your lender's standard variable rate is almost always going to be higher than the benefit of looking at what new rates are potentially available, even though they are elevated right now. Third, first-time buyers. And this one I want to spend a moment on because there are actually 2 opportunities here if you are prepared to act. Yes, affordability ratios are better than they were in 2021, but there's something else. The market is quieter right now. Properties are just sitting there. Things aren't selling at the speed they were. And that means if you go in with a good broker behind you and a solid offer, you have negotiating power. Price reductions are on the table in a way that they simply weren't 2 or 3 years ago. And that brings me to sellers. Because if you are genuinely serious about moving, and I mean genuinely serious, not just testing the water, then you need to hear this. The market dictates the price. Not your estate agent and not you, the market. And right now the market is telling you something very clearly through the data that we've just looked at. Buyers are cautious, affordability is stretched, and transactions are taking longer. If your property isn't moving, there is a reason. The hard truth is that listening to what the market is saying and pricing accordingly is the only way through that. The sellers who accept that will move. The ones who don't will be sitting on the market this time next year. So that's your week in mortgages and property. a lot of moving parts, but the through line is clear. The people who need this market to get easier are the ones being squeezed the hardest right now. If any of this is relevant to your situation, whether you're buying, selling, remortgaging, or just trying to make sense of it all, get in touch. My details are below. As always, thanks for watching. Please subscribe if you found this useful. It genuinely does help us, and I'll see you next week. Take care.